They're doing. Everybody just jumping in. Okay, there we go. We'll see. Yo, what's up? What's going on, people? What's going on? Welcome. As you join the chat, please let me know where you're joining from. Thank you for joining me today. We're going to be talking about how to pick single stocks. But I'm going to also put a caveat with this whole talk that we're going to have today. Picking single stocks is difficult, takes a lot of time. However, it is something that I love to do. But we'll talk about how you should think through picking single stocks. Please put down in the comments, where are you guys joining me from? Welcome to everybody. Man, we got people joining in. Where are you guys joining from? We got Jacksonville, Florida. No offense, but Florida, my brother's down there, and every time I go visit him, I'm always like, it's special. I guess that's the word that I'll use for Florida. It's special. It's a real special place. We always see something interesting. I'm gonna say that. We always see something interesting. Let me know where you're joining from. Put it down in the comments. And then we'll get started of how to think through picking single stocks. But before we get into single stocks, we'll talk about the investing mindset as a whole and things that you should think about when you start investing. Because I think when it comes to investing, the most important thing is the mindset that you have with investing. I think a lot of us lose more money because we don't think about things properly and because we just jump in and out of stuff and we don't think through what it is that we're doing. How special? Yeah, I mean, it's a very special place. It's a very special place, Florida. But anyway, yeah. So before we get into talking about how to pick single stocks, the first thing that I always tell anybody who's trying to get into investing, the very first thing is, do you have your personal finances in order? Do you have all your personal ducks in a row? Like your personal finance, that's very important, because when it comes to investing, it is, if you don't have that stuff in a row, you're going to be making a lot of terrible decisions in the markets. So do you have an emergency fund? Are you still in debt? All these things play a big role as to how you think through your investment, because a lot of times we're looking for a shortcut. We're looking for shortcuts because we have this thing weighing us down in the background, and we're thinking through like, yo, how do I pay this off? How do I do that? I need to make money very quickly. But the problem is, whenever you're trying to make money quickly, whenever you're trying to find a shortcut in the market, that's when the market laughs and says, we got another one. We got another one today. We got another one in our palms. We got another one. That's when we start seeing people who jump into stocks, trying to jump in on the hype, and then they end up getting burned. So very important that we keep that in mind, is like, we got to take care of our personal finances. We got to handle the things that we already know that's already in our hands. We got to handle those things. So, and then after that, I would advise that even before you start trying to pick single stocks, do you know anything about investing in general? Do you know how to invest in ETFs? Do you know how to invest in index funds? Because if you don't understand those things and you're just trying to jump right into single stocks, which is not a bad thing for sure. I mean, single stocks is an awesome thing and it can make you a lot of money if you know what you're doing. But I also think that it's important that we know how to balance things off, right? For me, for example, I started off investing in index funds. I mean, to this day, because I know that I'm dumb. I'm gonna make stupid decisions, and I never want to be completely wiped out from making some kind of investing decision where the company ends up going bankrupt or something like that, and I lose all my money. I never want to go back to set zero. I don't want to go back to zero, because when I lose to zero, it takes me double amount of time for me to get back to the position that I was in. By the way, if you're just joining into the live stream, please put down in the comments where you're joining from. Put down in the comments where you're joining from so I can shout you out. We already got one person from Jacksonville, Florida joining us in the chat. So please put down where you're joining from so I can shout you out and know where it's been. Been a year. I am trying to learn the stock market. I feel you. I mean, I'm still learning. Every single day is a new opportunity for me to learn something. It's a new day for me to figure something else out. Oh, we got Austin, Texas, where all the tech folks are moving to. We got Orlando. Okay, welcome. Oh, Dr. Black Barbie, you're back in the chat. Thank you for joining us today. I appreciate you. We got Orlando, we got Austin, we got a lot of Florida folks in the chat today. But like I was saying, it's very important that you understand that. But yeah, so let's go into the 4 questions that I always ask myself about whenever I'm trying to invest in single stocks. Whenever I'm trying to invest into single stocks, I ask myself these 4 questions. Question number 1, what does the company do? We got New Jersey in the house. What's up? Sizu, welcome. We got New Jersey, we got Greensboro. I'm guessing that's North Carolina with Requel. Welcome. Shout out to all you guys joining from all over the place. Thank you for joining me today. I'm using this stash out, but realizing I need more knowledge. Hey, we all need more knowledge. It's a learning experience. I can tell you that much. Even the greatest investor of all time, Warren Buffett, he released something in his memo, and he lost a bunch of money investing in a company. Ibo Kwenu, hey, what's up, my guy OJ? But he lost a bunch of money, and he was like, it's a learning experience. Everything is a learning experience. When it comes to investing, we're not gonna bat 1,000, but it's how we bat, and it's what we decide to hit at. Because when it comes to picking stocks, it's not just picking all of them. It's you get pitched a bunch of different ideas. There's going to be a bunch of companies coming at you. There's always going to be a company. There's always going to be a possible 10x stock. If you watch TikTok for 5 seconds, you know that there's a bunch of people telling you, buy this stock, it's about to explode. Buy this stock, it's about to go 1,000% plus. Buy this stock, it's about to do this. There's so many stocks, so many companies, but picking the right ones. Not just picking the right ones, and we'll talk about it later on, but picking them at the right prices. What's up? Welcome to everybody joining the chat. So I use SoFi too. Actually, I use a bunch of different platforms because one of the things is I like to test all of these out. Also, I like free money. So whenever they offer any kind of promotional deals, I end up signing up for brokerage accounts. I use Robinhood because I got a free share. I use Webull. Well, I don't really use Webull, but I got Webull because they were giving away 4 free shares. I opened SoFi because they were giving me some money. I literally will open a brokerage account, put a little bit of money into that thing, test it out so I can get some free money. And then if I find the platform to be useful, I'll keep using it. But right now, I only use Robinhood and M1 Finance are my 2 primary brokerages that I use, at least when I'm talking about investing on my own and picking single stocks. But on the other hand, with my IRA, I use Fidelity. Fidelity is my platform for IRA. By the way, another suggestion to everybody, make sure that you have an IRA because that's a tax advantage account. And I made a video today where I was really pissed because somebody was making a video about insurance and combining insurance with investing, and those videos really tick me off. Those are called whole life policies. Whole life policies are not meant for most people. It's a very specific group of people that benefit from it, but you have a bunch of insurance salesmen trying to sell people products that they don't need, and it really grinds my gears whenever I see those videos because you're just taking advantage of people and the ignorance of people because people don't know this thing, because people don't live inside this world. But anyway, I'm gonna stop my rant because it really annoys me whenever I see that. But anyway, let's get back on topic. What was I talking about? Oh yeah, that's right, investing. All right, I'm gonna calm down. USA, you're right. You're right, Dr. Black. You're right. What are some good upcoming stocks? We'll talk about that and how you can look for it. I'm not gonna tell you stocks to pick. I'm gonna give you the mindset. Like they say, rather than giving a man a fish for a day, you can teach a man how to fish, and he can fit and he can eat for a lifetime. So that's what I'm gonna say. What are some of your companies to look into for in the second quarter? And I'll explain a lot of this stuff as we go through the comments. But yeah, so. When it comes to investing, one of the things is there's going to be a bunch of companies that are going to fly at you. There's always going to be suggestions. There's always going to be companies flying at you. But picking the right ones at the right prices will dictate how much money you're going to end up making. Like I like to tell, me and my brother were talking about this the other night. A good company can be a horrible investment. A great company can be a horrible investment if you don't buy them at the right price, but we'll get to that. So there are 4 questions that I ask myself whenever I'm trying to invest in a company. Question number 1, what does this company do? But more importantly, how does this company make money? Because I think a lot of us may know what a company does, but we don't really understand how they make their money, which is much more of a bigger deal when we're trying to invest in a company. We have to stop, we can't think of just ourselves as consumers of a product. We can no longer, when you start investing, you can't see yourself as just a consumer of a product. You have to start seeing yourself as a manager. You have to start seeing yourself as a business person. You have to start seeing yourself looking as an investor into a business and saying, how is it that they're making their money? What is it that they're doing that makes them their money? How do they make their money? For example, some of the companies that I love, and I'm gonna use standard companies. So Google, I'm just gonna suggest that if you know the answer to this question, just put it in the chat. How do you think Google makes its money? I'm just gonna put that out there. We all use Google services in one way, shape, or form. Maybe it's YouTube, maybe it's search. However, we all use their services. Do you guys know how they make their money? Because this is some of the things that you have to start thinking about when it comes to investing. Like, I just want to see if anybody, because this is, I'm trying to like start getting everybody into the mindset of like how you look through companies. Ads, exactly. So the biggest way Google makes their money is ads. But do you know there's other ways that Google makes money as well? It may not be the biggest size of their money, but the other way Google makes their money is cloud. Google provides cloud services to different companies. That's another way that Google makes money. Google also makes hardware products, the Nest products, the Google Pixel line of phones. Google also software, exactly, to schools. They also make the Google Chromebooks, which they give to schools. They leverage all of these things. And then you have the Google suite of products that competes against the Microsoft Word products. So knowing, okay, how this is all the ways that they make their money. And then also they have other products, which they like to call it they have Waymo, which is a autonomous driving industry within Google. So understanding, you have to know all of these things about a company. You have to know, like, okay, they're trying to go into this field so they can keep growing. They're going into cloud service production so they can keep growing. They're giving away their Chromebooks for next to nothing so they can go ahead and get into the mind of kids while the kids are extremely young. So that's the first question you got to ask yourself is like, how does this business make money? What are all the sources of income that this business has? And then that leads you to question number 2, which is, what is the moat of a business? So back in the medieval ages, when you had castle rages and castle breaches and all of these things, one of the ways that castles used to defend themselves was to build something called a moat. I'll just show you guys a picture of a moat because it's, a moat is it's an ancient time term, but I think it's important for us to all understand what a moat is and to maybe see a picture of what a moat is. I'm gonna switch my camera real quick so that everybody sees this. So these are moats. So back in the medieval ages, they used to build castles around these things. They'll put water around the castle, and then the castle will be in the middle, and then there's only one way in and out. You only have one way that you can get into the castle. There's only one way you can get out of the castle. That is important because what that basically is showing us is how a business is in a defensive position. What is it about this business that makes it so dominant, that makes other businesses hard to compete against it? We're talking about Google. Google is so large because it's been around for so long. It's collected so much data that if we're going to search for anything, who's going to go to Bing? Ain't nobody going on Bing. Nobody's using Apple search. Nobody is using any other version of search. Everybody is going to go to Google because we know that we can get the result that we want from Google. We know that we can definitely use that Google result for sure. When using your Roth IRA to invest, how to go about it, or is it the same as stash? So we'll talk about that in a second. In a second, we'll get into Roth IRAs close to the end of the video. We'll get to the Roth IRAs once we finish talking about the 4 questions for single stocks. I think there were a couple other questions on Roth IRAs. So yeah, you have to, what is it that makes this business special? I like to say, what is it about this business? What is the Mamba mentality of this business that makes it special, that makes people keep using their services, keep buying their services, keep coming back to them? Like, for example, Apple. What is it about Apple that everyone just says, you know what? I am going to buy. People keep buying, like they keep raising the prices and people are like, I'm still going to buy an Apple product. Apple released a $550 pair of headphones that looked like a purse and people still went out and bought it. That thing sold out immediately. It went on sale. It sold out immediately, and since then it's basically been selling out. It's hard to get a pair of those new AirPod Maxes. Why? Because Apple's brand carries a lot of weight. Apple's whole thing, its whole shtick, carries a whole lot of weight. Everyone wants an Apple product. Everyone wants one. And Apple does a great job of making sure that their products work very well together. And so whenever people are trying to buy something new, they're like, oh, I need a new laptop. It's like, if I get a MacBook, it's going to go very well with my iPhone. And so they end up getting a MacBook. And then they get an Apple Watch. And then they get the headphones. And then, it's not even like a second guess thing. Like, they're definitely going to buy the product. So that's the second question. You have to figure out, what is it that makes this company special? What is it that makes other businesses hard to compete with this company? What is it that this business does that makes it so special? So that's the second thing you got to ask yourself. And then the third thing, and this one is a little bit harder to figure out, is what is the management team like? Because a great business can be ruined by bad management. A great business can be ruined by bad management. We can look at a company like GE. GE was one of the best companies in the US. Like, it was the top. It was literally number one. It was the number one company in the United States. Now look at where GE is now. Almost going bankrupt a few years ago. Having to sell off multiple parts of its division just so they can survive. Why? Because for a few years they had horrible management. They had horrible management, which kept on trying to which kept on doing increasing the dividend, even though they weren't bringing in as much profits, just so they can spike the share price. They were buying back shares when they knew they couldn't afford to buy back shares, just so it can look good. So, I mean, that's another thing that you have to always look at. Always look at, like, the management team. And how do you look at a management team? There are three ways you look at a management team. One, you can look at the numbers. If you go on any most investor websites, you can find a number called return on investment. Return on investment, which tells me how well the management team uses the money that I'm putting into the business. You can also look at another number called return on equity. This shows how well the management have been doing for the shareholders. Are they doing something where I'm getting more equity? In other words, if I give them $2, they're able to give me back $1.50 or something, or they're able to give me back $1. They're able to make my $2 become $3. That's what I want to see. Return on invested capital as well, because I want to see how well are you using the capital that I'm giving you to invest? How well are you working with that? And then also listening to shareholder calls, reading the shareholder letter, reading the CEO's letter to shareholders, listening to interviews, trying to understand the mindset of the leaderships. Because when you understand the mindset of the leadership, when you understand what they're talking about, what they're doing on a regular basis, then you can say, okay, this is a business that I can go with, or this is a business that I don't want to go with. It's a lot of people think picking single stocks is just, oh, I like that company, I'm gonna buy it. Nah, this is something that takes a lot of research. It's just like you trying to buy a computer. You don't just, if you're trying to find a good computer to buy, unless you're buying a MacBook and you're just like, give me the newest MacBook. There's no shortcut with investing. It's a lot of research. It's a whole lot of research that you have to do. You have to read these earning calls. You have to listen to interviews. You have to do your own research. And then the fourth question that you got to ask yourself is, what is the valuation? And this is the hardest part when it comes to investing. Because like I said at the very beginning, a good company can be a horrible investment. For example, back in 2000, Microsoft was trading at about $58 a share. It hit a peak. This was right before the dot-com bubble. It was trading about $58 a share. And then after the dot-com bubble, it crashed down to about $10 a share. It took Microsoft almost 16 years for it to get back up to that $58 a share. So if you had bought Microsoft when it was $58 a share, would you have been able to hold on when you saw your money basically go down 80%? You lose 80% of your money in Microsoft. So let's say you put in $10,000 in Microsoft, you lost $8,000. Boom, gone. Would you have kept holding on for 16 years later when Microsoft went parabolic recently, where it has quadrupled from that price point? It's trading at about $230 something now. Would you have been able to hold on? That's where the valuation comes in. It's not like Microsoft was a bad business. We all know Microsoft. Microsoft was making money, like making a lot of money during that time period. It wasn't like Microsoft just disappeared off the face of the earth. It was making money. But the problem is, even a great business can be a horrible investment because we're buying at overpriced points. We're buying at when the business is already taken off. For example, a lot of people right now are buying into companies like a lot of EV companies. Everybody's buying into an EV company. Everybody's like, oh, EV is the next big thing, which EV is, but the problem is, who are the winners going to be? Or are we just saying that, oh, definitely every single one of these companies are going to sell 20 million plus cars? That's not going to happen. That's not going to happen. Like, some of these EV companies are going to go bankrupt, whether we like it or not. So the question is, which are the ones that are going to be around here for a while? And then the other question you have to ask yourself is, what are they trading at right now? So it's always important that we figure out what is the entry point. And to be honest, answering the question of the valuation of a business is extremely difficult. Extremely difficult. I'm still learning how to do it. There's a few calculations that you can use. Some shortcuts that a lot of people will do as a quick reference guide is the PE ratio. But even then, that doesn't tell you everything you need to know. The PE ratio is a price to earnings ratio, which tells us like if it's above, usually if the price to earnings ratio is above 15, if it's above 15, then it's seen as overvalued. If it's below 15, it's seen as undervalued. But then you can't always use that number because we've had businesses like Amazon, which had a PE ratio that was always flying high. But however, Amazon was worth it. So then you have other ratios like the PEG ratio, which is a price to earnings to growth ratio. But even then, it's still not the best at telling you if a business is doing well. There are other ratios like price to sales, there's price to free cash flow, there's a bunch of ratios. You do a lot of research and learn about this stuff. But I always do something called discounted cash flow. Discounted cash flow. In other words, I'm going to, based off of what the company has been doing in the previous years, I'm going to determine a growth rate for that business, and then I'm going to forecast how much money that business is going to make in about 5 years. And then based off of that forecast, I'm going to discount back to what I believe the intrinsic value of that business is today. So for example, one of the businesses that right now that I'm focused on, for everybody who's asking me about what stock am I looking at and all this stuff, it doesn't change that often for me, if I'm being completely honest, because I try to stay in my circle of competency, and so I don't look at a lot of companies. There are very few companies that I look at, and I'm also learning that when it comes to picking single stocks, if I'm going to pick single stocks, I might as well go all in on a very few number of companies and then put my rest of my money in just the broad market ETF like VOO or VTI or QQQ or any one of those things. Because why am I, I might as well just have that in the background and then actually go double down on companies that I believe are underpriced. So one of the companies I'm looking at right now, or I've been looking at since September of last year, was Intel. Everybody was like, oh, Intel's dead, AMD is here to rule. Intel, forget about Intel. It's all about Nvidia, it's all about AMD. Forget Intel. Nobody cares about Intel anymore. Intel's failing. And it's like, whenever the market starts looking at a business, especially a business that's one of the few manufacturers of chips in the United States like that, I'm like, wait a minute, there might be an opportunity here. So after the pandemic happened, Intel was trading at about $40 something, and so I got intrigued. It was trading below a 8 PE ratio, and so I was like, wait, I need to look more into this business. And so I started doing research on Intel, and I found out that, wait a minute, Intel's got like, it's got like a 30%, it had a 30% ratio of profitability. And I was like, wait, what? Are you serious? Like, they're making that much money even though everything else is going on? Like, yeah, they were still making money. But the only problem I had when I was doing a lot of research with Intel was the management team. I went back and looked at the management team and I was like, I don't like the person who's their CEO. And so I didn't invest. That was a mistake on my part because they could have easily changed the CEO, which they did a couple months later, and then the stock has recovered. I wish I put more money in Intel because it went from trading about $40 and now it's trading about $65. That's what is that? That's a 50% return. And I know everybody's out here talking about I got 100% return, but the thing is my downside was so limited, plus I was getting dividends that it's like, yo, it's an easy investment choice for me at that point. Yeah, exactly, 64.55. So like, it was an easy call, you make that money, boom. So like, yeah, so I mean, that's how I look through, the CEO was a finance guy. He was focused more about trying to protect the Intel than trying to invest into the business. And he was focused less on actual innovation and actually finding ways to be innovative and it was so focused on cutting corners. I don't want that. Especially for tech companies, I need tech companies to be always investing back in a business and always looking for new ways to make themselves better. It's why AMD ended up catching up to Intel and then passing Intel. That should have never, ever happened. That should not happen where AMD was able to catch up with Intel. That should have not happened. But because the CEO was so focused on just the profitability, cutting costs, that hit Intel bad. And so Intel has fluttered away, AMD has started to rise. AMD should not be on the same level as Intel, but it is. But the good news is, with everything that's happening with the chip shortage and with the fact that we're going into a stage of deglobalizing, where a lot more people are trying to do stuff in the United States, Intel is one of the few, actually it's pretty much the only manufacturer of chips here in the United States. So that's a big edge. Again, remember that word, that's a moat that Intel has. AMD has to contract out its manufacturing to TSMC, which is in Taiwan. So that's a moat that Intel has around itself. That's another reason why I invested in Intel. But yeah. So yeah, I mean, those are the 4 questions you always got to ask yourself is like, how does this business make money? Like, what is this business and how does it make its money? Like, it's not just about, oh, I know this business. It's like, no. Are they profitable? Do they make money? How do they make their money? Very important. Then you follow up with, what is the moat of this business? What is it that makes this business special? Then you ask yourself, what is the management team like? Because if it's a trash management team, even if it's a great business, for example, we can look at like Apple. If Apple didn't have Tim Cook, Apple won't be the $2 trillion company that we know today. Tim Cook took the reins from Steve Jobs and then ran with it and made the company actually what it is now. We can look at Microsoft. Microsoft with Satya Nadella, he's helping the company come out of the way that it's been seen for years. So that's my take on how to look through companies. And then valuation. It's going to take you time to learn about valuation. One of the tricks, and I'll say this to everybody, one thing that I did to learn when I first started investing, I didn't know how to value companies. I didn't know how to look at companies. I didn't know any of that. What I did was I just did dollar cost averaging, which is where every week or every month, I would just buy into a company slowly. Because I still wanted, even though I shouldn't be saying this because this is a bad idea, because it teaches you bad habits, but I still like, for companies that I believed in the long term, like for example, Microsoft and Apple, I just bought into them slowly because they had amazing cash flow. I didn't do this for companies like, I also love companies, one of the companies that I'm really loving, but it's new, Roblox. I'm not gonna do I'm not gonna do dollar cost averaging where I'm just buying stocks into it because it hasn't proven itself yet. I love the company, I love what they're about, but it hasn't proven itself yet. So I'm not about to put any money into that thing and dollar cost average. On the other hand, with Microsoft and Apple, $2 trillion and $1.7 trillion company with unbelievable cash flows, almost no debt. Or if they have any debt, their cash position can cover their debt like that. Literally, they have so much money in the bank, they could be a country all by themselves. I'm okay with just cash, dollar cost averaging into it. And that's one thing that I'll suggest. If you're scared and you don't know exactly what to look for, you don't know how to pick single stocks, first of all, I'll suggest just go ETFs. It's a lot of work to try and pick single stocks. It's a lot of work. It's a lot of research. It's a lot of boring Saturdays where you're reading freaking financial papers. And it's a lot of boring Saturdays where you're just listening to a CEO talk about the latest held up in a manufacturing thing somewhere. It's a lot of boring details. But if you enjoy it, then it's fun. But if you don't enjoy it, if you would rather be doing something else, I would definitely caution you and say, single stocks might not be for you, because if you don't do all the dirty work, all the dirty stuff, you lose a lot of money. But even more than that, if you don't know why you're investing into a business after doing your own research and coming to a conclusion for yourself, every time there's any kind of dip in the market, you're going to get scared, and more than likely you're going to sell out of it. That's what happened to me when I first started. I went into a dip. I didn't know what I was doing. I got scared. I sold. And it was the worst decision that I made. You lose a lot of money. On the other hand, if you know about the business, you know why you invested into the business, when it dips a little bit, you get excited because you're like, I get to buy a good company on the low. Hey, on the low. Hey, and you get excited because now you're getting a higher return, a higher potential return on a business that you know that has cash flow to continue to pump into the business. For example, last year, Disney, which I regret this decision, last year Disney was trading extremely low, like ridiculously. It was in around $80 something. And I looked at Disney and I said, this company does not deserve to be trading at an $80 ratio, at $80 price point. Its PE ratio was down below, I think it was like 10-ish. And I was like, this company is super undervalued. Like, this company should be should be growing. It's going to grow a lot more, because I looked at Disney and I said, Disney Plus is a thing. Did nobody watch Mandalorian? Like, did nobody watch that? No, it was just me, maybe? Okay, well, whatever. I looked at it and I was like, the parks are closed because of coronavirus, but they're gonna open back up, and Disney makes a bunch of money. So like, ESPN is still owned by Disney, Hulu is owned by Disney. So like, I was scratching my head like, what is everybody freaking out about? Like, why is everybody? And I was like, I need to invest in Disney. But at that point in time, I was still dumb. This is the thing I always say. I was still very dumb. Instead of investing in Disney, which was extremely underpriced, I went chasing after Microsoft and Apple, dollar cost averaging into Microsoft and Apple. And rather than just buying a bunch into Disney, because now Disney is trading at about 190 something. Let me look. Let me see where it's at. And just cry about how much money I just lost. Yeah, $189. That's Disney has doubled or tripled in price since the time that I thought about investing. That's doubled, 100% return. So I just look at that and I'm just like, man, I was dumb. I was so dumb. Like, and that's what I'm saying. It's just understanding how to invest is very important. It's hard. It takes a lot of time. It takes a lot of effort. But if you put your time, you get books. Oh, by the way, let me recommend a few books real quick. All right, so I'm gonna recommend a few books because I think this might help a few people. The first book, Financial Intelligence. This book helped me understand financial terms because I did not graduate from finance. I'm an engineer by school. So everything that I've learned, I've basically learned by watching YouTube videos, listening to podcasts, and reading books. So this one helped me understand financial terms. And then I read this book, The Intelligent Investor. This is extremely hard to read. I would not start with this one. I started with this one. I was super confused, but it's a good book. And I think we'll come back to this one. This is something else. Then this book, One Up on Wall Street, is a great book by Peter Lynch. It will teach you basically how to go about thinking about stocks. Very good book. I love it. Peter Lynch is one of my favorite writers. And then Common Stocks and Uncommon Profits. This book will actually tell you how to value stocks. Very good book. And then I have a bunch of Peter Lynch books. Basically, all Peter Lynch books are basically all the same. But yeah, those are the books that I'll recommend. The first one, Financial Intelligence, which just teaches you how to understand financial terms. Then I would go into One Up on Wall Street, which just teaches you how to look at stocks and how to think. And then I would go into Philip Fisher's Common Stocks, Uncommon Profits. And then I'll finish off with The Intelligent Investor, which tells you how to value stocks. So that's what I do. And then most of the time I'm at home. I listen to a lot of videos by Warren Buffett, just talking through investing mindset. I listen to a lot of people doing a lot of the same stuff. I go on YouTube to search how to do discounted cash flow calculation to understand how to do that. And that's why I'm like stuck to it, because it's the only one that I really know how to do. And then I've embedded myself in this finance world where I'm looking for information, right? I'm always looking for information. All right, so let's get right into the questions that we had coming in. Las Vegas in the house. What's up? We got Nevada. What's up, Las Vegas? Yes, I use SoFi as well. Using stat. Let's see. Okay, cool. So let's start with this question. We got a question. Should we invest in Robinhood as a stock? I don't know. That comes down to you. Would I invest in Robinhood? Robinhood is going to be huge. The problem is I try to stay away from IPOs because I've been burned by IPOs a lot, because usually there's a lot of hype when a company is about to IPO. And so, like, for example, Roblox at its IPO went up 50%. Was it deserving to go up 50%? I wouldn't say so, and I love the company. Airbnb went up almost 100% on its IPO debut. You had DoorDash that exploded. The thing is, like, all of these companies are now extremely overvalued in my estimation. So I'm not gonna touch them yet. Like, I might put like $10 in them just to have a little bit of money sitting and reminding me to, like, hey, keep up with that company. Pay attention to their earnings. Pay attention to what they're doing with their money. Make sure you're paying attention to what the leadership is doing. Read up on that company just to keep it in mind, but I would not put a substantial amount of money into any company that just IPO'd, because I need to know more about the business and the operations. And when a company IPOs, there's not a whole lot. There's not a whole lot to know about the company. What are good upcoming stocks? Like I said, I literally stay within the same range of stocks. I'm learning that being diversified. So here's how I think through stocks. If you have under $10,000 invested, if you have $0 to $10,000, you shouldn't have any more than 5 companies you're invested into. You shouldn't have more than 5 companies. I'm learning that the hard way. I made a mistake when I get started. I was like, there's so many companies. I was like a kid in a candy store. I was like, there's so many good companies. I want that one, and that one, and that one, and that one, and that one. And then it was like, I would get stocks that shut up and my conviction will be good and I'll be right on the stock and it'll shut up 100%, but 100% of $10 is just $20. So like, I wasn't making money. So I've learned to narrow myself down to a few number of stocks and I stay there. Now I look at other companies and I'll be like, oh, that's interesting. I mean, Coinbase is about to IPO. I'm like, oh, that's interesting. I'm not going to invest in them. There's a bunch of other companies, but I mean, I can't tell you any good upcoming stocks. That's something that, and this is something that I didn't talk about. First of all, every one of us has an edge in the sense of there's something special about us when it comes to picking stocks. There are certain companies that we know something about, even though we don't feel like we do, but we know something about that other people do not know. For example, maybe I'll use example of me. I am extremely into technology. I love watching tech reviews. I love watching tech videos. I love watching stuff like that. And so 2 years ago, I wasn't doing anything with tech, but 2 years ago, we started seeing AMD start to rise up, where a lot of tech reviewers were recommending AMD to their watchers, to the show watchers, and they were recommending AMD over Intel because they were like, for the cost plus the what you get out of it, the cost to, what's the word I'm looking for? I don't know why I can't talk. The cost to reward, your cost versus what you were getting out of the system, you were getting a banger. And so they were recommending AMD. If I was investing at that point in time, I would have started buying into AMD because AMD was about $10. Now AMD is, I think, 90 something bucks. Let me see. Yeah, AMD is $81. It was trading at about, if we go year to date, actually we'll say 1 year. 1 year, let's go 5 years. 5 years ago, this was 2017, it was $12. The world didn't notice that AMD was doing well until well into 2019. That's when AMD stock started to take off. So my point is, whether it's at your place of work, there are certain softwares that you might use at work. Maybe there are certain businesses that you work with at work and you notice like, yo, we don't like working with them, but we like working with them. Maybe there's a software where it's like, yo, their software was amazing, their software sucked. So there are certain things that we take for granted that we have access to every single day. For example, my sister works in healthcare. And so like I was talking to her about telemedicine. And I was like, so what do you guys use at work? And she was telling me all these different companies. And I was like, that is your thing that you know more about than anybody else. And when you know more about something than anybody else, it gives you an advantage in investing. So just pay attention. Like, don't just go through the world. Actually watch, like take a step back and watch the world and pay attention. What is my niece? Why is my niece playing this Roblox game? That's how I paid attention to Roblox. Or what are all these kids all of a sudden doing on TikTok? Very important. Pay attention to trends. Pay attention to what people are doing, because the world, regular people, consumers are just going to keep using the products. As an investor, you have to pay attention. You have to listen. What are people talking about on Twitter? What is everybody doing? Like, pay attention to what's going on around you rather than just being in it. Like, remove yourself every once in a while and just scan the room. Like, back in the old days, I remember like people were bashing on Apple and we're like, oh, Apple is dead. Apple is dead. But people who made a lot of money investing in Apple were like, wait a minute. My daughter always wants an iPhone. My son always wants an iPod. And all this stuff, they're just like, what are they talking about? Apple is the bomb. And so they bought Apple and it made them a bunch of money. So just remove yourself and then pay attention to what's going on around you so that you can be like, okay, I see a trend. But be careful of trends, because trends can also falter, because trends don't stay around forever. It has to be a company, like we said, is actually making money. So that answers that question. I just opened a Roth IRA. Do you recommend custodial Roth IRA for your kids? Yeah, definitely. I mean, you definitely open a custodial. Just make sure, in order to open a custodial Roth IRA, your kid has to be making some kind of income. So what you can do is you can literally, I think some people open like if you have an LLC, you can hire your kid and then you can kind of pay them and then just put the money into the Roth IRA. I don't know how to set that whole thing up, but there are videos on YouTube and all that stuff to talk about custodial Roth IRAs. But definitely custodial Roth IRAs or 529s, which is for college only. There's some other ones. I forget what the other ones are, but definitely I would open something for kids. I mean, for me, I love the kids, so you always got to do something for the kid, in my opinion. What does your portfolio look like in my Roth IRA? In my Roth IRA, it's simply let me pull it up real quick. It's Fidelity's zero. I literally have one thing in my Roth IRA, and it's Fidelity's Zero Total Market Index Fund. I just want to track the market in my Roth IRA because in the long term, I can't tell you what companies are going to be the best companies 10 years from now. It may still be Apple, it may still be Google, it may still be Microsoft. I don't know. So I'm just going to track and I don't know what companies it's going to be in 40 years. So all I want to do in that account is just put money in it. Just put money in it. Just put more money in it is all I'm going to do with that. When using your Roth IRA to invest, how do you go about it? So all I do is literally, I have my Roth IRA with Fidelity set up. By the way, I have a video of this on YouTube of how to set up automatic investments with a Fidelity account. And literally, I just put in money into it every 2 weeks. Money is taken directly out of my paycheck and goes right into it and gets invested in the same, like I said earlier, the Fidelity Zero Target Total Market Index Fund. And I just keep putting money in it. Like I just keep putting money in it. And I don't pay attention. I just see that money as like, I never had it in the first place. It's just comes out of my account, goes right into it. I don't pay attention. It's automatically done. In 40 years time, when I'm 60 something or 50 and I'm able to get access to it, then yeah. Did I say 50? I'm definitely not going to be 50 in 40 years. I'm going to be 60 something. 66. So at that point, then I'm going to just, eat the fruits of my labor. But right now, I just don't even want to think about it. I just want it to keep growing. And at some point, it will hit the millionaire status for me. Let's see. You ever got into Forex trading? Nope, because I don't care about currencies like that. It's too much activity. I want to be, as much as I'm active with investing, I'm not even that active with my investments. It's very boring. Like there's not a lot of action. Like you see a lot of people make videos about investing. Investing is extremely boring. Most of the time, what you're doing is listening to an interview, reading financial reports, and that's it. That's literally what you do most of the time. You ain't buying, you ain't selling. Most of the time you do a bunch of research and then you find out, man, I can't even buy this company anyway because it's overvalued. And then you don't buy it. It's very boring. It's a very boring thing to invest. So I don't do trading. And because also that's good for my mental health because I don't have to time when to buy, when to sell. I don't have to watch a screen for too long to buy. I don't always have to do all the research. I have 2 dogs and a business. That's the thing. And if you don't have the time to do research, it's okay. Like, I think it's like, just know what you're getting yourself into when it comes to investing. Know what it is that you're getting yourself into. If you say, yo, I want to do single stocks, it's time. You have to put the dedication to say that, because what you're saying when you say that you want to be a single stock investor is you're saying that I am better and I can do better than the market. I am smarter than most people. As much as we may feel like, oh, I'm not that arrogant. That's what you're saying. Because what you're saying is I can make more money just by picking stocks on my own rather than following the market. At the same time, it's very important if you want to be a good investor to have the humility to know that I may be wrong. But being a single stock investor, what I'm saying is I can pick stocks because the way my portfolio is set up is about 80% of my money goes to just goes to index funds and ETFs that track the market. 80% of my money. 20% of my money is going to single stocks. And my belief is because of there's a whether it's a saying or a quote or whatever, is basically it's 80% of your 20% of efforts leads to 80% of your results. Right? 20% of effort leads to 80% of results. So my thinking is I am going to be good enough at investing, and I should be good enough at picking stocks that even though I'm just putting 20% of my money into single stocks, they should outperform every single thing in the market. Like, I should beat the market. That's very arrogant. That's extremely arrogant position to be in. At the same time, I have to have the humility to say, I may be wrong. And that's a hard position to be in, because to be so confident in a position makes you arrogant, because you think you're right and everybody else is wrong. Because when Intel is being traded at $40-something, you're basically telling the world that you guys are dumb. Why are you not buying Intel right now? I know more than you do. I'm gonna buy Intel. You're basically arrogantly saying to the world, y'all are stupid. I know more than you. Most people don't want to agree that that's what you're saying, but that's what you're saying. So when you're wrong, when you're really wrong, Ray Dalio always talks about the fact that he was so arrogant and he thought that the market was going to crash, and he was wrong. And he got ridiculed. That's the thing about investing. Most investors don't talk. You know why most investors don't talk? Because they don't want to be ridiculed when they're wrong about an investing position, right? For a long time, Cathie Wood, who's everybody's darling right now, was ridiculed because she believed in Tesla. Now she's sitting on the throne. She's the queen. Workhorse or Neo, for me, neither. Because both of them, everybody's predicting that all these EV car companies are going to be good. I gotta see it. Neo in China is gonna be good. I don't invest in Chinese companies. Workhorse still doesn't even have one. I don't think they even have a contract yet for anybody to buy any of their stuff. About to graduate in 2 weeks with my bachelor in health science. If I knew I would have a major in finance. No. Because finance you can learn. Like, you can learn this stuff on your own. Actually, a lot of engineers, after a couple of years working as engineers, they go into finance and they're able to do it. Why? Because it doesn't take, to be honest, finance is not like health science. Like, health science is a ball. First of all, for a lot of us, instead of trying to figure out all this finance stuff, we just need to first of all make income. Like, you need money to be invested. You need some kind of working capital to get invested, and then you need to find ways to grow your capital so you can keep investing. So I mean, yes, sometimes I feel that way too, but definitely I still, my passion is still very much engineering. I love engineering. I love what I do every single day. Finance, I wouldn't want to work in the finance world. I do this on the side because it's fun. Like, this is fun for me. I talk to a lot of my friends who are in finance, and their lives are brutal. Like, the hours they have to work, the things they have to do, I don't want to do that. So, I mean, yeah, you could make a bunch of money in that, but I just don't like the lifestyle. But I feel you sometimes. I'm currently buying, however, I already know I'm allowing my stocks to sit. Yes, that's good. Long-term investing is the best bet. I'm doing now, just selling when it's dipping. Don't sell. If you believe in a company long-term, if the stock drops, then you should be buying more if you have money. If you, like, for example, during the dip, there was a double dip back in August. Was it August or was it September? I think August or September. After the stocks had been climbing for a while, there was a dip where Apple dropped like 10%, Microsoft dropped like 10%. I bought because I believed in Apple and I believed in Microsoft. And that's where it comes down to, like, have I done all my research? Do I have a conviction that even though this company is going one way, I believe after all the research I did, basically all the research we're doing is just so that when things turn upside down, I don't go sell. Rather, I hold on to the fact that I still believe my thesis is true. And so I'm gonna hold on. That's what I'm doing. Howdy. What's up? Disney is back. The parks have been at 100% max capacity since February. Exactly. Well, and it's not full capacity yet in California. Plus, they're building other parks as well. Plus, the cruise line is going to be open eventually. They're making a lot of money. Love your content and education, man. You're helping me out immensely. Hey, man, I'm trying as best as I can. I'll continue to do it. Podcast recommendation. Where's my phone? Oh, my phone is up here. Actually, hold on. Podcast recommendations. I recommend, give me 1 second, let me pull it up. So a few podcasts that I love to listen to when it comes to finance and all this stuff. One, the Prof G Show. It doesn't really teach you how to value companies. He just talks about companies and talks about it in a way that I love to listen to. Those are news podcasts. The Investopedia Express, very good podcast. The Compound Show, very good podcast. Animal Spirits, very good podcast. What else? Master in Business is also pretty good. Which other podcast? Planet Money, good podcast. The Money Guy Show, also really good. And yeah, those are the ones that I'll recommend for people. Some of the stuff might fly over your head. Some of them might be too deep. Also, Rambling Mind, which is my podcast. Go check out my podcast, Rambling Mind, link in the bio, where we talk about some stuff as well. Is it too late to invest in Energy XLE? I don't know. I really cannot tell you if it's too late. Also, this is another thing. If you're trying to invest, ETFs are a great way to do it. If you're like, I don't know how to pick single stocks, ETFs, you just dollar cost average into it and you're good. Your money is going to grow over time. You can do industry specific ETFs. It's like, I don't really understand anything that has to do with energy, so I just buy the XLE. Or I don't understand anything that has to do with technology, I buy XLK. Very easy way to invest into stocks and get you started. Or I think technology is the future, so QQQ. Or I think the United States is going to grow, so VOO or VTI. Any one of those. So, it's a way to get started. Does that mean having 2 ETFs? I don't remember when you asked that question. Is it too late to invest in Energy XLE? I don't know. That's something that you have to decide for yourself. I personally, I'm not even investing in that anyway, and I don't pay too much attention to that industry, so I can't tell you whether it's a yay or a nay. I don't know everything. I just know a few things. Is that 4 to 5 companies and ETFs, or is 4 to 5 companies plus a couple of ETFs? So, because I know that I was actually talking to a friend of mine. His name is Tolu. He does great behavioral economic stuff. And I was telling him, I don't even think about my Roth IRA and my 401k when I'm investing. And he was like, you got to factor that in, because if you don't factor that in, you're not taking enough risk on the other hand. So what I started doing is, in my Robinhood portfolio, because I hate the fact that Robinhood is so freaking gamified, I do ETFs. I have one ETF in there called SCHD. It is an ETF for dividends, and I just put $50 into that every 2 weeks. Every 2 weeks, $50 into that. I actually added ARK, which was a dumb decision on my part. I don't know why I did it. It was like a YOLO play, and I was just like, I might as well put some money into ARK. I lost half that money, and I was like, well, that was dumb of me, so I'm just gonna let that sit. But SCHD, I just put $50 every 2 weeks. On the other hand, I have my M1 Finance portfolio where I put $150 every 2 weeks, where I let it sit. And then when I see that, okay, I want to buy something, at first, what I was doing with the M1 Finance was every 2 weeks, $100, I would just put it into either Microsoft or Apple. I was trying to build out my position in Microsoft and Apple, because as much as I say 5 companies, I still want to hedge against my bets. So I believe Microsoft and Apple are going to be here in the long term. So I wanted to build those positions up. So the entirety of last year, I just bought Microsoft and Apple stock. I just kept on buying. Even though to some degree, some people might say they're overvalued. I'm not going to disagree. I'm going to say trading at a PE ratio of about 30 something right now. They probably are overvalued, but I think they're fine. I like the cash flow. I like the dividend. I like the fact that they're still going to make money. Even if I lose 50% of the money in there, they're going to recover and do much better. Usually after a crash is when you see some of the best returns. So I did that all of last year. So now what I'm focused on is companies that I'm going to get the best returns on. I'm focused on not just invest dollar for cost average, and I'm just going to put money on the side, because the market is very frothy right now. So I'm just keeping money on the sidelines for when anything happens, I might buy into it. But in my Robinhood, I have one ETF, SCHD, where I put $50 every 2 weeks. $50 every 2 weeks. I don't care what's going on in the market, $50 is going into it. And then I have companies that I'm looking at and watching for whenever they fall, I'm buying more. AMD up, just like the one I mentioned to you, UPath. What's your overall cash position compared to your investments? So, cash position right now is 1%, and that's because I reran some of my cash flow. I reran some DCF on Intel, and I reran some DCF, discounted cash flow. When I say DCF, discounted cash flow on Intel, on Amazon, and on Google. I should not be saying this because everybody's just gonna follow my ideas on this, and I really do not follow. This is not financial advice. Please do not follow. But basically, I found, to me, where they're trading right now, I believe that there's a 30% still 30% growth of opportunity for Intel. Its intrinsic value, I believe, is about $100 a share. For Amazon, for Google is right now is still very underrated in my opinion. I'm not gonna like, I think they're like, I think it was 20 or 30% as well. And so I put a lot of my money into Google. I put a lot of my money to Google, Amazon, and Intel because I think all of them have great upside potential, and I'm trying to build out those positions. So it is likely that I will not have a whole lot of cash on hand for a little bit, but because I'm just going to be trying to just stuff, because all of them have been punished recently due to the slight correction with everybody, with the inflation fears and everything. I'm just like stuffing the money into them because I'm like, this is an opportunity, so I'm just gonna take my money, like I'm just type of thing. What's your overall? So it's about 1%. Emergency funds, I don't calculate my emergency fund with that because my emergency fund is something completely different. I don't think about my emergency fund. That's a completely separate cash position. Cash position to me is anything that I'm going to invest in the market. And plus I also, and if I'm going to take total, I'll say like 50% isn't cash because emergencies happen. I've been very wrong. It's okay to be wrong. It's just learning from your mistakes and growing from there. Nintendo is making a park bullish. I mean, they did make one. It's in Japan. I saw a video of it. I am not bullish or bearish on Nintendo. I don't know anything about their business. I just know that they make video games. I am bullish on the video game industry, but the way that I'm playing the video game industry is not the way most people are thinking. It's through Microsoft, because I think Microsoft is extremely underrated in the video game industry and nobody pays attention to Microsoft because everybody thinks Microsoft's an old company. But yet, they keep doing amazing things like the $20 billion contract that they just had with the Army because they're making Halo headsets. Everybody forgets that Microsoft makes AR headsets. I'm just saying. ETFs charge fees, right? Yeah. Oh, speaking of fees on ETFs, make sure that whenever you are investing in any ETF, just pay attention to the fees. Fees can cost you a lot in the long run. So I tried to stay with fees under like 0.1%, but I broke that rule when I invested in ARK. And this is why we have rules. You don't break your rules because your rules end up saving you. It's like having safeguards. It's like, no, don't look over there. Don't look over there. Stop it. Stop it. Stop it. It's like, no, I gotta see. And then, you get burned. So I've learned, by the way, go check out ETF.com if you want to like see and understand ETFs and understand all of that. Is really good. So yeah. Where's the best place to learn how to value a stock? To be honest, I don't even know. Like, I read a lot of books and I watch a lot of YouTube videos. There's a guy on YouTube called Sven Carlin, Investing with Sven Carlin on YouTube. He makes, I think my internet dropped out on my computer for some reason. His name is Sven Carlin and he makes really good videos. There's also another guy on YouTube called, let me see if I can find, who else? There's a lot of different videos. There's a lot of different people that I watch on YouTube, but I'll start with Sven Carlin, SVEN Carlin. He makes really good videos of teaching people how to think through investing. Another person that I watched on YouTube that helped me immensely when I was trying to learn how to invest and trying to learn how to do dollar cost averaging and rather do discounted cash flow is a guy named it's a channel called Learn to Invest. He makes really good videos as well. I would definitely go check him out. And then another channel that I really like when it comes to me trying to learn how to do value investing is, let me see. Yeah, those are, I'll say start with there. Start with Learn to Invest, which is a YouTube channel, and then also Sven Carlin. Let me see. His channel is called, make sure I'm telling you the right thing. Value Investing with Sven Carlin. SVEN Carlin. He's a PhD. He makes excellent videos. And those are the two people that I'll recommend, that anybody who's just starting out and trying to learn, very, very good. Also, there's another guy. he's a professor. He has all these like really in depth. For all those who are thinking like I need to go to finance school, you know what? Go on YouTube. There's this guy. His name is, oh man, what's his name? Man, hold on one second. Why am I not remembering this? Shoot. Why am I not remembering his name right now? See, this is a problem when you have like 300 subs and you watch so much content, you forget about almost anything and everything. And why is my internet acting a fool right now? Because this is not cool. Come on, YouTube. Stop messing with me. Hold on one second. Sorry guys. I really want to share this with you. For anybody who's really trying to go ham on this stuff. He has lectures on YouTube on economics, and then on straight up, oh yeah, Ashvat Damodaran, which is ASWATHDAMODARAN. He is an actual NYU professor, but he does value videos on YouTube. It's very in depth. A lot of his videos are like 2 hours long, but it's really good. I'm gonna just, you know what? I'm gonna put some. Let me put some. Let me chat so that you guys can see it. Can I chat? Can I? Oh, there we go. Okay. Nope. Let me chat. Okay. So the channels I mentioned. Sorry, I'm gonna put it like this for a minute. So Ashwat Damodaran. Can I just? Come on. There we go. Value investing with Sven Carlin and learn to invest. Yeah. So those are the 3 channels that I recommend you go check out. Now, if you want books, if you're more of a reader, okay, here we go. Okay, I would recommend this book. This book took me 3 months last year to read through because it's extremely, look at this, thick. It's like thick with 2 C's, THICC. So it's a thick one. It's a thick book. So it's a lot, it's very condensed, it's very jam-packed with a lot of information. It might get hard, but instead of starting off with this book, another book that helped me, this book really helped me. Rule Number 1 by Phil Town really helped me, like broke everything down, told me where I could go find stuff, even though I don't use any of the resources in the book, but it really helped me to like understand value investing. These books, Peter Lynch's books, are just good for mental mindset of like how to look at companies. But I will say this: if you want to get started investing, don't go chasing after stocks like. No offense to anybody who loves Neo. Don't go chasing after stocks like Neo or GameStop or AMC or what's a company that everybody loves to talk about? Palantir or anything that's like super fresh. Don't chase that. Please don't chase that, because the problem with chasing those companies is $1 Million Mindset book. I've never read it. I've never read it. I don't know anything about it. But just be careful, because starting out with because it's easier for me to do analysis on proven companies than it is to do an analysis on a brand new company. It's extremely hard to do an analysis on a brand new company. Also, I'll just say, like, seriously look at companies that you already use their products. Start there. Like, do you use their products? Start with that. Like, for example, do you use an Apple phone? Maybe dollar cost average into Apple. Do you use Facebook? Well, everybody uses Facebook and Instagram. Facebook, Instagram, Google, Amazon, like products that you already use on a regular basis. Start with those companies. You don't have to go find the brand new shiny companies. Like, no, you'll be fine. You ain't gotta go find the brand new stuff. Just start with simple companies. And you go. I promise you. Like, for example, I was listening to Peter Lynch interview. Peter Lynch is one of the greatest investors of all time. For a long time, he had like a 20% return on investment, which is almost impossible to do. But he was saying like, when Walmart first went public, you could have invested anywhere after 10 years that Walmart was a public company and still made 35 times your money. That's a lot of money. So don't rush. Take your time with it. It's gonna be a lot of learnings. Like during a bull market, like right now we're in a bull market, is a perfect time to learn. It's a perfect time to put some money. Maybe you put some money into index funds, but then you put some money on the side into like, think of it this way: put money into your brokerage account that you don't touch. Don't even think about touching the money. Just put it there, so that as you're learning and you're putting money away, eventually you're gonna get to the point where you're like, I have the confidence to make a big bet on a company where I put like $1,000 or $2,000, depending on where you're starting off, and you just put it into a company because you're like, I believe this company is going to be big, and so I'm gonna put my money in it. I've done my calculations. I've done all my research. I understand their numbers. I understand their profitability. I understand the margin of return on investment. I understand all of it. I expect this much money back, and I expect it to come back to me in this amount of time. Boom, I'm making this decision. But but more important than that, I'll just say start with ETFs, dog. Like literally, if you have no idea what you're doing, start with ETFs. I'll say start with an ETF like VOO. Start with an ETF like VTI. Start with an ETF like QQQ. Just start with an ETF, because just getting the market return will make you a millionaire. Especially if you're investing in your IRA. First of all, in your IRA or 401k or anything like that, getting the market return, just literally getting 10% return over a 20-year period. If you're investing, let's say you're investing like $1,000 a month, in 20 years, you become a millionaire. So, definitely would definitely start off with that. You don't have to become a millionaire, to make money investing. You don't have to pick stocks. It's fun, it's exciting, it's interesting. I find it very interesting, but you don't have to pick stocks. Like, if we're being honest, like literally, you can make a lot of money just by tracking the market. A lot of people lose more money trying to pick stocks than make money picking stocks. But yeah, so that's just my take on investing as a whole. That's how I go through companies. It's learning to be arrogant, but at the same time humble, to know that I probably will be wrong, or I'm probably making a mistake. And it's just knowing what I'm doing, knowing what I'm buying. Like if you start off with just knowing what you buy, you won't freak out every time the market goes up and down, because you'll be like, yo, this company is good. Why will I freak out? So yeah, and I would definitely, that would be where I would start. But yeah, I hope I was able to help in some way, shape, or form. I may have just completely, and slanging rocks, I may have just completely confused everybody with everything that I talked about in this video, but sometimes getting confused and then finding your way through the confusion might be helpful. Another day, we'll just have to, what I'm gonna do, I think I'm gonna do this at some point, is literally go through a company as an example of how to research a company. I'll probably put that on YouTube and just do like a quick breakdown of like, this is what I look for when I'm researching a company. These are the websites that I use. These are my resources, all that stuff. But thank you guys so much. Shout out to you, Owen. Thank you for joining. Thank you for every single person that joined the call today. I'm gonna go eat some food because my stomach is telling me that it's hungry and you need some sustenance. So I am going to go and eat some food and sustain the stomach, because the stomach must be full before we go to sleep. Good night, everybody. I'll catch y'all. YouTube channel is my name. Just search my name, or just go to my bio and you find it there as well. All right. Good night, folks. Y'all take care. Stay safe. God bless, and remember, generosity is always greater than greed. God bless each and every single one of y'all. Peace.